Good morning, students. Today we are going to cover the topic of mergers and acquisitions and corporate restructuring. So let us start first of all by understanding what are the main types of mergers. Let us try to discuss some of the key points on mergers that will help us to do the concept building. So if we talk about different types of M&As, the first case that can be seen is, for example, there is a company called A and there is a company called B. And this is the most common example, which is used in a lot of questions as well. So what we say is that A and B are two separate companies before merger. After merger, B merges into A. So B merges into A. That merges means all the balance sheet of B goes and sits into A's balance sheets. Those gets consolidated and B's identity is dissolved. Now B is not there anymore and A is the new entity itself. So now only there is a new entity called A, which has merged, which has taken B in itself as a merged entity. Okay. This is case number one. This can be case number one in case of a M&A. Now, case number two can be A and B again are two separate entities. A acquires shares in B. So A acquires a stake, a good stake, which is let's say more than 50%, which makes B as a subsidiary of A, correct? So that means A acquires stake in B Limited. And after acquisition of stake also, both A Limited and B Limited continue to work as independent companies. There is no dissolution here, correct? So what we call this relationship as, let's say, this is a holding and this is a subsidiary company. Let's say I'm saying 55%, for example, correct? And in this, there is no dissolution. This is commonly referred to as acquisition, right? This is how the companies are acquired. This is typically called as merger. Case one is called as merger, correct? Now, coming to case number three. Now, case number three, for example, A have two businesses. For example, business one and business two. A Limited is into two different types of businesses. Now, if we talk from A's perspective, if they want to hive off or if they want to separate one business and put it into a new company, that is also kind of a restructuring only, correct? That is also kind of a merger and acquisition only. We will study what exactly technically we call this. So, but in this, I'm just explaining the cases. So A will be, let's say, continuing with business one, and there is a new company formed in which they will transfer the business two, which is B2. And this A Limited and B Limited will now function as a separate legal entities, correct? And case number four can be A and B today are separate companies, but both of them dissolve and there is a finally new entity called C. Both of them gets dissolved. Both of them transfers their assets and liabilities to a new company called C. This is the new entity in this case. This is also one of the form of mergers and acquisitions. So these four cases typically are the broad cases that I have discussed with you on the different types of mergers and acquisitions, correct? So the first type is simply A in A's balance sheet, the B's assets and liabilities are taken over through a merger and B itself gets dissolved. And the settlement for B Limited happens. Let's say first to the creditors, then to the preference shareholders, then to the equity shareholders. Similarly, in case two, B and A, both of them remain as is. A Limited acquired stake in B Limited. Case number three is a case of hive-off demerger, in which the one of the business is separated out and put it under a separate company. And case number 4 is both of them gets merged and dissolved with a new company coming in place called as C Limited. Now, students, please note that in our C curriculum, so this mergers and acquisitions is actually across a lot of papers. So, for example, in paper number 1, we will study about the financial reporting part of it. How does the financial reporting happens? Paper number 2, which is in SFM, we will study about the valuation, the different kinds of valuations. How can we value that mergers, or what is the post-merger analysis? How to make sure that at the during the merger, both the shareholders of A Limited and B Limited are not at loss, or if what is the right swap ratio to be calculated. So all that commercial valuation will happen according to the principles laid out in the mergers and acquisitions. And then again, in the law paper, you will also study the regulatory aspects of it, correct? So in that you will study that what typically what approval should be there, how the scheme should be made, correct? So all those things will be there. Now, coming to our specific part of the mergers and acquisitions. So now, students, I will take the most relevant case from the above, which is the first case. Okay, we will take that case and we will elaborate it further. So we said that A and B are two separate companies. B merges into A Limited. Okay, and B gets dissolved. Once B gets dissolved and B merges into A, then how does settlement happens from the A's end? Because A will not be able to pay anything to B Limited, correct? Why? Because B Limited is getting dissolved. Ultimately, whatever is B Limited's net assets, those belong to the shareholders of B Limited, correct? Because ultimately it is going to the shareholders of the B Limited after dissolution. Now, students, if you see the purchase consideration, the term is called as purchase consideration. Now, what is this purchase consideration? For B merging into A will have to pay some kind of a purchase consideration, correct? Because A is purchasing B, hence A have to pay something that is called as purchase consideration. Now, it can take what all forms, what all kinds of purchase consideration can be. For our discussion, we are restricting purchase consideration into 3 types. Okay. First one is that I'm putting it here. First one is equity shares of A Limited issued to shareholders of B Limited. This can be the first form of the settlement of purchase consideration. Now, students, please take a note here that A Limited can settle the purchase consideration in kind by issuing the equity shares of A Limited itself, not to the B Limited, but to the B Limited's shareholders, correct? So please keep this point in mind, because this point would be very relevant in most of the practical questions that we will be solving. We have to always see that the shares are issued to the shareholders of the B Limited, which is getting merged into A Limited. Okay. And equity shares of A Limited will be definitely issued, because going forward, A Limited is going to sustain. So this is one. Second is cash payment, simple. Now, this cash payment would mean that they will go outside to purchase a company, they will pay cash and take the company, correct? Ultimately, this cash payment also will go to the shareholders of B Limited only, correct? Ultimately, this cash payment will also go to the shareholders of B Limited after reducing all the liabilities and all, correct? Then, third part can be mix of one and 2. Something can be in cash, something can be in equity shares of the A Limited. Okay. So these are the 3 broad types of settlement of a purchase consideration. Okay, students. I hope the situation is very much clear that we are talking about a situation where B Limited is getting merged into A Limited, B Limited is getting dissolved, and now A Limited wants to settle the purchase consideration. And A Limited will settle by issuing the equity shares of itself to the shareholders of B Limited. That's number 1. Number 2, cash payment, and number 3, mix of 1 and 2. Now, a basic question arises here that what is the right swap ratio? What is the right swap ratio? Now, what is swap ratio? Swap ratio is how much shares to be issued for one equity share of B Limited. Correct? How much equity share of A Limited to be issued against one equity share of B Limited. That is called as swap ratio. So in what ratio should we issue that? It can't be 1:1. 1:1 means that both the companies stands on equal footing, but that is not the case. Cash payment, what is the right value? What is the right value for cash payment? That is another question to us. Correct? So hence, we want to know that what is the right swap ratio in case we are issuing the equity shares, or what is the right valuation of the company in case we are going to pay through cash. So these are the 2 basic questions. Now, our discussion will be around these things only, that how to calculate these things and how to do the post-merger analysis. Now, students, if I tell you, now let us take some of the common formulas that all of you must be knowing, and some of the new things that I am going to add. Let us try to revise all of them before we go to the questions, because that will make sure that at one place all our discussion points or concepts are ready to be built. Now, students, first of all, what we have saw is that there are different types of steps. First step is to estimate the equity. Estimate A Limited equity. Then we will estimate B Limited equity. Correct? This I am telling you from the step-by-step point of view. Then third step will be, we will calculate the swap ratio. Calculate swap ratio. Swap ratio, for calculating swap ratio, you need to know that what is the equity of A Limited and B Limited. I mean to say, what is the right value or what is the right metrics. We will study how to calculate the swap ratio in detail. Then last part will be how to do the post-merger analysis. So our discussion in the entire M&A will be around these points only. Somewhere we will be doing the post-merger analysis, somewhere we will be calculating the swap ratio, somewhere we will be calculating the basics to calculate the swap ratio, which is the first and second step. Okay. Now coming to formulas. So I think a lot of things all of you would have studied earlier in the previous level. So first of all is a PE ratio, which is called as price earning ratio. So this, we say that this is price divided by earnings, or in a proper language, we say that market price per share divided by the earnings per share. Okay. Or we can also say that instead of per share, you take the total market value. Market value, or we can say this as market capitalization. Correct? So the total market value divided by the total earnings. Whichever way you do, that is called as PE ratio, because higher the PE ratio will tell you that higher the multiple that the company is operating for the earnings in the market. For example, if the PE ratio is 10 and you are able to earn 1 rupee, that means your correct value in the market is 10 rupees, which is 10 multiplied by 1. Correct? Can we now rewrite these 3-4 different types of PE ratio to calculate one of the missing part? For example, if you are given PE ratio and you are given price, can you calculate the earnings? Yes. Similarly, if you are given earnings and you have to calculate price, can you calculate price with PE ratio and earnings? Yes. So those all things will be part and parcel of the question. We have to see that which element in this is given and which element has to be calculated. Now, the swap ratio. What is the right swap ratio? Now, there are different ways to calculate the swap ratio. Sometimes questions itself says that you have to follow this method. Sometimes the question is silent. So we will cover what are the different methods to calculate swap ratio. Number one. So for all our this thing, so A Limited is actually acquiring company and B Limited is the target company. Why A Limited is acquiring company? Because A Limited is acquiring, correct? And B Limited is the target company. I will be using A Limited and B Limited only in the formulas. So the first ratio to calculate is market price per share of B Limited divided by market price per share of A Limited. So this we call as, this is the swap ratio basis price. This is the swap ratio basis price. Now, this is a very simple calculation in which we take that what is the current market price of the target company and what is the current market price of the acquiring company, correct? In which we will come to know if there is 10 rupees of worth of market price that I'm acquiring and my current value, because I am acquiring, so my current value is 12 rupees. So I will be able to pay 10 by 12, correct, as a ratio. Okay. So this is the MPS basis price swap ratio. Then second is basis the earnings per share, again of B Limited divided by, sorry, not MPS, but EPS. Earnings per share of B Limited divided by earnings per share of A Limited. Okay, these are earnings based swap ratio. All these formulas we will apply to understand that what are the impacts coming out to be. Okay. Then the third one will be book value per share. See, this is the market price per share. This is the earnings per share. And there is a term called book value per share. Book value means the whatever is as per the books, the value is coming out to be per share. That is called as book value per share of B Limited again divided by book value per share of A Limited. This is basis the book value. This will also give you the swap ratio. Okay. So these are the three different types of swap ratio that I have discussed. Fourth type we will discuss, I will do the last question. Okay. But as of now, what I want all of you to understand is that the B Limited, which is getting merged, that MPS, EPS or BVPS, anything we can use to calculate the swap ratio basis whatever the question's requirement is. Correct? Now, coming to the next part. So the EPS, EPS, how we calculate EPS? It's very simple, which is profit attributable to equity shareholders divided by number of equity shares. This is how we calculate the earnings per share, correct? Now, the market value is equal to MPS multiplied by number of shares. I'm just trying to brush up all the formulas here so that we are ready, at least from the understanding point of view. And can we also say that using the PE ratio, if we have to calculate the market price, then PE ratio multiplied by earnings per share will give us the market price. Correct, students? Because what is PE ratio? PE ratio is MPS divided by EPS. So if we have to calculate the MPS, then we will take the market price. Sumit Jain is asking, book value and net assets value are same? Yes, Sumit. Both of them are same. Because the book value is, again, we will arrive at using the net assets only, which is total assets minus total liabilities. That will be our book value. Okay, so one more thing now in this. Now we have said that profits attributable to equity shareholders divided by the number of equity shares. Now, how to calculate the, so, or see, this is A, and I'm putting, or in case there is something mentioned on the preference dividend as well, then EPS, how will it look like? Can I write this as PAT, which is profit after tax, minus preference dividend, correct, divided by number of equity shares. Correct, students? In case there is a preference dividend that is given in the question, then definitely we will do PAT minus preference dividend, which is nothing but the profits attributable to equity shareholders only, whichever way we say. Now, sometimes for calculating the EPS, so as I told you in this part, see, these all formulas will work for step 1 and step 2, correct? Because till now we are estimating the A limited's some KPI, similarly B limited's, and similarly the swap ratio. Now, what about post-merger analysis? See, in case of post-merger analysis also, sometimes question might ask you to calculate the EPS after merger. EPS of A limited after merger. Correct? After merger, what is going to be the EPS? Which we also say that post EPS merger. Post EPS merger. Now, how do we calculate this? Very easy again. So as of now, I'm just using the PAT here, which is, I'm assuming that preference dividend is not there. If it is there, we will reduce it. So I'm saying that PAT of A limited plus PAT of B limited. Because first of all, if the merger is happening, both of them, we have to add the profits to arrive at the total profits attributable to the equity shareholders. Okay. Plus, sometimes there is a synergy gain. Sometimes because of the merger, what happens is the A plus B is not equal to the absolute addition. It is something, A plus B is basically the result of that is higher than the absolute addition. So that we call as synergy gain. Now, for example, B limited was a supplier of A limited. And now A limited is acquiring B limited, correct? Now both of them, because A limited used to purchase some items from B limited, and hence A limited used to incur extra cost if we see both of them as standalone. But now since both of them are one company, this is called as backward integration. Hence, there will be something extra apart from the regular PAT of A and regular PAT of B. That is called as synergy gain. Correct? Synergy gain means because of both of them coming together, there is some extra amount that is there on the table. This whole divided by the equity shares of A Limited, whatever is the current equity shares issued of A Limited plus equity shares issued to the shareholders of B Limited. Correct? Whatever equity shares we, as I told you that we will be issuing the equity shares to the shareholders of B Limited. So equity shares issued to shareholders of B Limited. That's all. Correct? That's all. So this will give us the EPS after merger of A Limited. Okay. So this is again the case one where we are settling through shares. Now there can be a case where we are not going to settle it through shares, but through payment. Okay. This actually we call as this as a acquirer company. You can just put it because this is acquiring. This is acquiring the target company. Okay. So now if we are going through the cash payment, okay. Now in case of a cash payment, what we will do, we will still do the PAT A plus PAT B. The numerator will be same, correct? Plus synergy gain. All these things we will add here. Then we will divide it by the number of shares of A Limited that are issued, the total number of shares. But in this, we have done one mistake. What is that? We have paid cash, correct? Now, presently, A Limited was holding some cash and it has paid it. That means if it is paying the cash, A Limited will not be able to generate the returns on that cash, because what we say is that cash is part of the working capital. It can be used to generate some of the returns, correct? Either we can invest it. If we would have invested it, we would have got some kind of a return. So hence, that opportunity cost has to be reduced from the overall numerator. So synergy gain minus cash paid, whatever total cash that we have paid multiplied by the return percentage that we would have got. And sometimes in question, the tax rate is also given. Now, if the return is gross of tax, then we will have to do 1 minus tax rate. So we have to multiply with 1 minus tax rate to arrive at the net cash impact, net return impact on the cash paid for the acquisition. So this is going to be their revised earnings, the numerator, and denominator is the number of shares of A Limited that are already issued. So I'm just putting here T is equal to the tax rate. And this part we have taken the cash paid into return percentage multiplied by 1 minus T for the opportunity lost on the cash that we would have invested somewhere and got some kind of a return. Okay, students. Sairam is asking, sir, synergy gain, it's a goodwill amount. No, Sairam. See, what is goodwill? I'll tell you. That is not goodwill. Synergy is actually the actual gain that comes to you. It is a tangible gain. Correct? Because of the integration, as I told you, the backward integration, or because of some kind of economies of scale, or because of, let's say, capacity increase, there will be. So, for example, A Limited and B Limited, both of them are running into the same type of industry. Both of them have a similar kind of a factory. A Limited have a capacity to produce 10,000 units. B Limited have a capacity to produce 5,000 units. Okay, I'll give a good example on synergy now. So I'm saying that A Limited has a capacity to produce 10,000 units. B Limited has a capacity to produce, let's say, 4,000 units, correct? In totality, can they produce 14,000 units? Yes, there is no constraint there. But while producing 10,000 units, A Limited have, there is some direct cost, there is some overheads, correct? So I'm talking about the fixed overheads here. These fixed overheads, for example, the supervisor's salary, for example, the admin staff, the administration related staff, or for example, the board of directors of A Limited, all of them were getting some kind of remuneration. The similar set of remuneration was given to the B Limited's employees as well. But now, since the B Limited is dissolved and all the B Limited business is transferred to A Limited, that means the common, for now, earlier that cost used to be incurred for 10,000 units. Now we will incur the same cost for 14,000 units, and the B Limited's cost will not be there. The fixed overheads will not be there. So don't you think that there is a synergy gain? Because if we just simply do PAT A, PAT B, then we are ignoring the savings in the fixed overhead on account of the common supervisory layer. Correct? So hence, we have to add something more, which is called a synergy gain. This is called a synergy gain. This is not goodwill. This is the real tangible gain that you will see in your P&L after merger. Correct? Now, what is goodwill? Goodwill is something. Now, for example, if you go and purchase something for a higher amount than its real worth, that is called as goodwill. So goodwill, basically, for example, now this land, okay, the real worth of land is 10 crores, but you end up paying 12 crores. Actual, you are paying 12 crores. The value, the intrinsic value, I can say, the intrinsic value is 10 crores. So then 2 crore is called as goodwill. So goodwill is actually paying higher than what the intrinsic value is. That is called as goodwill. Correct. This is not our discussion area, but still we just wanted to tell you the difference. Okay, but synergy gain is the real tangible gain that you will see. Okay. Yeah, so this part is complete. Then what is the post merger EPS in case we are settling through shares, in case we are paying through cash? Then sometimes the next part is, sometimes the question asks us to calculate the effect on EPS of both the shareholders post merger. Correct? So first of all, in our previous discussion, we have calculated the EPS post merger. Correct? Now we are going to calculate the effect on EPS post merger. So this again we will say from two perspectives. One is the equity shareholders of A Limited, and second one is the equity shareholders of B Limited. So let's see it from the point of view of acquirer company, which is A Limited. So A Limited, what we can say is that there is a post-merger EPS that we just now saw how to calculate. Then there is a pre-merger EPS. Whatever this amount comes out to be, this is the net impact on the acquirer company. This is the net impact on acquirer company. Whether it is a positive or it is a negative, whatever it is a net impact. Correct? We will take the post-merger EPS. We will reduce the pre-merger EPS. Good morning, Shubham. Then target company, which is B Limited. In this case, whatever is the post-merger EPS, we cannot take it as is. We cannot take it as is. Why? Because of swap ratio. Now, For example, one equity shareholder of B Limited has not got one equity share of A Limited. Correct? It is not 1:1. If it is 1:1, then it is okay to take the post-merger EPS of A Limited as is. But what we have to do is we have to adjusted for swap ratio. So the post-merger EPS of A Limited, we have to adjust it for the swap ratio. This amount will now be comparable with the pre-merger EPS of B Limited. Pre-merger EPS of B Limited. And now both of them can be compared and see what is the net impact on target company's shareholders after merger. Okay, students. So the only point to be noted here is that in case of an acquirer company, we can just simply take EPS post-merger, pre-merger, because one equity share for A Limited remains as one equity share after the merger. But in case of a target company, one equity share of B Limited will not be equal to the one equity share in A Limited post-merger. Hence, we have to account for that swap ratio while doing the impact analysis. Yeah. This is first of all, we have calculated the EPS of both the entities together. Then we have calculated the EPS post merger, and then we have calculated the effect on EPS post merger. Correct? Using that complete chain. Now, what is called as value of acquisition? There is a term called value of acquisition. This is from the point of view of acquiring entity, which is A Limited. Value of merged entity, correct, minus value of acquiring company before merger. Simple. This we are calculating from A Limited's perspective. Now, students, this is a very simple thing. Value of acquisition. What is the value of acquisition? If I say that I am A Limited, I am going to acquire a company. My current value is 1,000 crores. Okay. My current value, this is the current A Limited's value. But after merger, my value will become 1,500 crores. This is post merger. Since my pre-merger value is 1,000 crore total value and post-merger value is 1,500 crore, that means the acquisitions value is 500 crores. Simple. Correct? Sairam is asking, sir, but in B Limited also incurring fixed cost to produce 4,000, that fixed cost also transferred to A Limited after merger. So that's what, Sairam, I was saying in the synergy gain example here, that some of the fixed costs will definitely be going. But some of the fixed cost, let's say the CEO's salary, let's say the board of directors, or let's say the top management, correct? Because you will not need more top management to produce 14,000 units instead of 10,000 units. You would need more labor, right? You would need more direct labor cost, but not the top management cost. Similarly, if you want to expand, you will need to pay more rent. That I agree. So that rent also as a fixed cost will go there, but to a smaller extent, not to a larger extent, because you still have the same go down where you can keep those goods. Or even if you want to expand, you can take the higher go down. But what I'm trying to say that still there will be some fixed cost that will not be transferred to A Limited. That will go off. For example, the board of directors or top management salary of B Limited. Correct? Because now they will not be required anymore. the same top management of A Limited can oversee the 14,000 units as well. Okay, Sairam, that is what I was trying to say. That is called as synergy. Some part will remain as is, some part will not, which will not be transferred as a fixed cost to A Limited. That is called as synergy gain, because that is a over and above gain that we are getting. So value of acquisition is clear. It's very easy from the perspective of the acquiring company. Now, the last part of this discussion, then we will go on to the questions, is sometimes we are required to calculate the gain loss to the shareholders of both acquiring company as well as target company. So I'm putting here both A Limited, B Limited, correct? So, or else let me put it like this. A Limited and B Limited. So A Limited market price of new, or I can say post merger. Post merger A Limited minus market price of pre-merger A Limited. Simple. See, how do we calculate there is a gain or loss to the shareholders? Always think it from the shareholders' perspective. They will always say that, okay, before merger, I had an equity share in A Limited, which had a price of 10 rupees. Now, after merger, that price has gone to 12. That means there is a 2 rupees gain that I am enjoying. Simple. So we will compare simply the market prices before merger and after merger to arrive at the gain or loss. So resultant will be gain / loss. If it increases, it is a gain. If it loses, it reduces, it is a loss. Now, for B Limited's shareholders, this we are talking from the perspective of shareholders again, because B Limited is already dissolved, correct? B Limited has no relevance here. We are talking from the perspective of shareholders. So MPS of post-merger A Limited, correct? Because now they're having the equity shares in A Limited post-merger, correct? But that we have to multiply with the swap ratio again. We cannot say that one shareholder in B Limited will have the same number of share, or let's say the one share in A Limited also, because of the swap ratio, correct? Because of the changes in the valuation. So hence we have to always consider as adjusted for the swap ratio, like we did in EPS, like we have did here for EPS as well, correct? We have multiplied with the swap ratio, and then we have to reduce the MPS of pre-merger B Limited, not A Limited. We have to compare B Limited, because shareholder of B Limited was holding the share of B Limited before merger. This will be the gain / loss. Simple. For the shareholders of B Limited. Now, students, you would already know that what is the market capitalization. Market capitalization is equal to market price per share multiplied by the number of equity shares outstanding, or we can say that issued. Whatever it is, we will use both the terms interchangeably. So the total number of shares issued multiplied by the market price per share, that will give us the market cap. Market cap means that this is the total market value of that particular entity. Now, for example, in that the promoters holding, I hope all of you know what are promoters. Promoters are the people who are, let's say, the founders of the company, who have formed the company. Those are called the promoters. So the promoters holding is, let's say, 60%, for example, or I'm saying it is X percentage, because they will enjoy a higher stake, because that's why they will be able to reap out more benefit, correct? So if the promoters holding is any X percentage and market capitalization is as per the above formula, there is a term called free float market capitalization. Free float market capitalization. Now, students, what does free float means? Free float means that whatever is held by promoters, that is not traded in the market, correct? Because otherwise promoters will lose. Promoters are not going to sell their stake. That is why they're called as promoters. They will continue to build upon their stake. They will only be selling the stake if they are in need of money, or they want to book some kind of a valuation profit, correct? Then only promoters are going to sell. But what we say is that freely that is available market capitalization to float in the market. The free float market capitalization is equal to the market cap, total market cap multiplied by 1 minus promoters holding. Simple. So 40% in case, let's say there is a 60% promoter holding. So 40% of the total market cap will be called as free float market capitalization. That means that market capitalization is able to freely float, is able to freely trade in the market. Okay. I hope I have covered substantially the concept building or the formula related part. Now let us go to the question number 1 to apply these formulas. Sairam is asking, sir, how market value of share is decided through same company or through BSE or NSE? Very good question, Sairam. See, now the market price is a function of two things. Roughly, it is a function of two things. One is the technical framework and one is the fundamental framework, correct? Fundamental analysis and technical analysis. So if we talk about from BSE or NSE perspective, BSE, NSE, since these are markets, and in markets always the prices are in equilibrium, or we can say that it is a game of demand and supply. Demand and supply, correct? So the from the market's perspective, it is the technical analysis, right? Basis the trend, basis the past history, the demand and supply, the prices will come. But if you talk about the book value per share adjusted for any value differences, that is called as fundamentals of the company, correct? What are the fundamentals on which the valuation is arrived? So actually, if you ask me, the actual market price in the company is reflective of both the elements, which is from the market perspective as well as from the fundamentals. Now in fundamentals, how strong are the financials, how strong is the balance sheet, how good is the profitability, all those things matters. Okay, Sairam. So that is how the market value is decided. Sumit Jain is asking, in calculation of market cap, we only consider free float market cap. No, Sumit. So as I told you that there are two terms. One is the market cap. While we have to calculate the market cap, we have to take the total equity shares, not only for the promoters or not only for the X of promoters, correct? We have to take the total equity shares. That is called as market cap. And there is a separate term called as free float market cap. In that, we have to exclude the promoters holding. That's all. Okay. Now coming to question number 1. Now question number 1 says that, now students, actually if you go through these all the questions, you will find that these questions have a lot of presence of data in this. So we have to structure the data in such a manner that we are able to read it properly, we are able to analyze it properly, and we are able to make use of it properly. Okay. So we will keep on noting what all informations are there in terms of the factual data. So first of all, we are saying that B Limited is a highly successful company and wishes to expand. by acquiring other firms. First of all, they are going to acquire the other firms. Its expected high growth in earnings and dividend is reflected in the PE ratio of 17. So I'm putting here B Limited. Let's again try to put the data in the structure form. PE ratio is given as 17. Okay. The board of directors of B Limited has been advised that if it were to take over firms with a lower PE ratio than its own, using a share for share exchange, then it could increase its reported earnings per share. Now they are saying that you have to take a lesser PE ratio company, acquire lesser PE ratio company so that you can increase your EPS. C Limited has been suggested as a possible target for a takeover. Now there is a new company called C Limited has been suggested for a takeover, which has a PE ratio of 10 and shares. Shares issued are 1 lakh here with a market price of 15. B Limited has 5 lakh shares is an issue with a share price of 12. So 5 lakh are the shares here and 12 is the MPS here. Correct? Calculate the change in earnings per share of B Limited if it acquires the whole of C Limited by issuing shares at its market price of 12. Simple. What they are saying is that now B Limited has taken over C Limited and it has issued shares at 12 rupees. Assume that, and now you have to calculate the effect on EPS. Correct? Now, how to calculate that? Total market value of C Limited is equal to 15 into 1 lakh. Correct? This is equal to 15 lakhs. This is the total market value. Correct? And can we calculate the earnings also? See, students, why I'm calculating the earnings? Because we have to calculate the change in earnings per share. Correct? For that, we have to calculate the original earnings for both of them. So the earnings here will be PE ratio. PE ratio is 10. Correct? Just a second. It is 15 lakh rupees divided by PE ratio. Simple. Correct? So the total market value divided by PE ratio will give you the total earnings. So the total earnings is 1,50,000. Correct? Similarly, the B Limited market value is equal to 5 lakh into 12, which is equal to 60 lakhs. So for this 60 lakhs, the earnings of B Limited is equal to 60 lakhs divided by the PE ratio, which is 17 rupees, 17 times. PE ratio is 17 times. That means the earnings comes out to be 352,941 if we calculate this. Now, students, how are we going to calculate the number of shares? What is the swap ratio? So the swap ratio, since the question has given you an indication that they will be issued at a market price of 12, so that means this is a swap ratio to be calculated using their respective prices. Correct? So 15 is for C Limited, which is the target company, and 12 is for B Limited, which is the acquiring company. This is what we have studied, correct? Basis the 1.25 equity share is to 1. Now, total number of shares to be issued by B Limited is equal to 1 lakh multiplied by 1.25, which is equal to 1,25,000. Simple. Okay. Hence, the total shares after merger in B Limited will be how much? 5 lakh is the existing shares plus 1,25,000 is the new shares. So 6,25,000 is the total shares. Then can we calculate EPS after merger is equal to earnings of A, earnings of B divided by the total shares. Simple. So it is 352,941 plus 1,50,000. This is the total earning divided by 6,25,000. Hence, the EPS is equal to 0.80. Okay. So this is post-merger EPS, students. Correct? Now, what is the pre-merger EPS? Present EPS is equal to 352,941 divided by 5 lakh. Total earnings divided by the number of shares. This is we are calculating for B Limited. 0.71. Now this 0.71 has increased to 0.80. So basically EPS is increased from 0.71 to 0.80. So there is a increase in the EPS. That is what the question has asked us to calculate. Calculate the change in earnings per share of B Limited. Simple. The change in the earnings per share of B Limited is from 0.71 to 0.80. This is the change. This has increased. Okay. I hope this question is clear to all of you. Students, please ask any question or any doubt that you have in this. So I think the basic structure remains same. See, for calculate, there can be two types of things in the post-merger analysis. One is calculate the gain or loss to the shareholders or calculate the effect on EPS. In this case, we have calculated the effect on EPS. Now that effect on EPS is calculated, first of all, using the pre-merger EPS and then calculating the post-merger EPS. Simple. Question number second. Elrond Limited plans to acquire Doom Limited. The relevant financial details of the two firms prior to the merger announcement are. So there are two companies. One is Elrond Limited. Second one is Doom Limited. And Doom Limited is the target company. Elrond Limited is the acquiring company. Acquirer/acquiring company. The relevant financial details of the two firms prior to the announcement are the market price is given and the number of shares outstanding is also given. 50, 25, 20 lakh and 10 lakhs. The merger is expected to generate gains, which has a present value of 200 lakhs. This is a synergy gain that is given. So they are saying that the merger is expected to generate gains, which is over and above their regular profits, which have a present value of 200 lakhs. That means this 200 lakhs can be added as a valuation gain. The exchange ratio is already given as 0.5. What is the true cost of merger from the point of view of Elrond Limited? Now, students, this is asking us to calculate the true cost of merger. Now, before we solve this, we need to understand that what is the true cost of merger. Just a second. So students, while calculating the gain or loss to the shareholders, correct? We have calculated the gain or loss from A Limited shareholders point of view and B Limited shareholders point of view. Now, there is a term called true cost of merger. Now, what is the true cost of merger? Whatever gain that B Limited shareholders are having, gain to shareholders of B Limited, that is called as true cost of merger. See, because the gain to the shareholders of B Limited is actually the cost for the merger for A Limited, correct? And the value of merger is equal to the gain to the shareholders of A Limited. So this is a target company we are saying, and this is the acquiring / acquirer company. Simple. So from the point of view of acquiring or acquirer company, which is A Limited, the value of merger is the gain to the shareholders of the acquiring company. And the cost of merger is equal to the gain to the shareholders of B Limited. That is called as the cost of merger. That is called as the true cost of merger, which is the target company itself. Okay. Now, question number second says to calculate the cost of the true cost of merger. The true cost of merger is nothing but we have to calculate the gain or loss from the point of view of the target company, which is from the point of view of Doom Limited. So if we say that, what is the exchange ratio? The swap ratio is already given. 0.5:1. Correct, students? It is already given 0.5:1. So that means the shareholders of Doom Limited will get how much shares? Already Doom Limited is having 10 lakh shares, correct? So that means they will get 5 lakhs shares, correct? So the percentage shareholding of Doom Limited is equal to 5 divided by 20 plus 5, correct? Because already Elron Limited is having a 20 lakh shares, 5 lakhs are further issued. So that means the total shareholding will be 5 divided by 25. In percentage terms, we can say that they will have a stake of 20%. Simple. Correct? This is nothing but the swap ratio only. Correct? This is the swap ratio only. We have calculated what is the percentage shareholding. Now, what is the value post merger? Because what we have to calculate the MPS difference for both pre-merger and post-merger from the Doom Limited perspective to arrive at the true cost of merger, correct? So hence we are calculating value post-merger will be 50 into 20. So 20 lakhs multiplied by the 50 rupees of market price for Enroll Limited. Similarly, for Doom Limited also, 25 rupees is the rupees per price and 10 lakh rupees is the number of shares. So this is actually the value for Doom Limited. And then there is a synergy gain also. The present value of synergy gain means this is already calculated as a value as on date, not as a P&L item. This is a total value calculated as on date. So that gives us 1450 lakhs. 1450 lakhs. Now the true cost of merger, from here only we can calculate true cost of merger will be 1450 multiplied by 20%, which is the shareholding of Doom Limited. So that means the total value that Doom Limited shareholders hold in the new entity in the after the merger. So it is 1450 into 20% minus what is the current price, or let's say what is the pre-merger value of Doom Limited, which is this. So this is equal to 40 lakhs. Simple. So the true cost of merger is equal to 40 lakhs. Now, how to explain this, students? Because some of you might be thinking we are just putting some fancy names to the concepts, but so what is the exact, why do we say it is a true cost? Why? Because if you see, students, the real value of the company of Doom Limited was 250 lakhs, correct? 25 into 10 lakh was 250 lakhs. But we ended up giving them a stake of 20% in the merged entity, which have a correct valuation of 1450 into 20% is how much? 1450 into 20% is 290. But we ended up giving them 290 lakh rupees worth of consideration in the form of stakeholdership in the new company. Hence, there is an extra cost of merger that has been paid from our pocket, which is 40 lakh rupees. That's why it is called as true cost of merger. And that's why we say that whatever is the gain that is happening to the target company's shareholders, that is always referred to as the true cost of merger. Okay, students. So this is about the second question. Let us go to the third question now. Now, third question is saying MK Limited is considering acquiring NN Limited. Okay, now this is also, they're asking about the acquisition only. Here you can say acquisition, mergers, both of them are used interchangeably. The following information is available. Now, MK Limited earnings after taxes given, and similarly for NN Limited, number of equity shares are also given, and the market value per share. Sorry. So the exchange of equity shares for acquisition is based on the current market value as above. They are saying, first of all, the exchange of equity shares is to be based on the current market value as above. That means the swap ratio will be basis the market price per share. That is a simple thing that they're wanting to convey to us. There is no synergy advantage available. So that's what they're saying. There is no synergy. You can assume A plus B is equal to A plus B. Find the earnings per share of company MK Limited after merger. Now this is very easy for us. So while calculating the first part, calculation of swap ratio. How are we going to calculate the swap ratio? So this is based on the market price, correct? Based on the market price, because the question itself has said to us. Now market price of 160, divided by 200. 160 is the target company and acquiring or acquirer company is 200. So this will give us as 0.80 is to 1. So for every 1 share in NN Limited, we will be issuing 0.80 share of MK Limited to the equity shareholders of NN Limited. Number of shares to be issued is equal to 0.80 multiplied by 3 lakh, which is equal to 2,40,000 shares. Sorry. So this is 2,40,000 shares are to be issued to the equity shareholders of NN Limited. Correct? We have calculated the swap ratio and we have calculated the total number of shares to be issued. Hence, the total shares post merger is how much? 2,40,000 plus originally issued was how much? 12 lakhs. So which makes it as 14,40,000. Correct? Coming to the earnings, because we have to calculate the EPS. Correct? For calculating the EPS, we need the total shares which we have got. Now we have to also see that what is the total earnings. Now total earnings is 60 lakh and 18 lakh. This is equal to 78 lakhs. So the EPS after merger $78 lakhs divided by 14,40,000. So this comes as 5.42 per share. So after merger, the EPS of what is the name of the company? MK Limited. Yeah, MK Limited is 5.42 per share. Now, what is the second part? Find the exchange ratio so that the shareholders of NL Limited would not be at loss. Now, students, one more thing we are going to add in our notes here is we have studied that there are three types of swap ratio currently that we can calculate. One is basis MPS, one is basis EPS, and one is basis book value per share. So whenever we talk about EPS, basis the earnings based model, that is the ratio at which the shareholders of target company would be at no loss. They will not be at loss while we say about the EPS. Okay. So hence we are going to use the same ratio here, exchange ratio, so that the shareholders of NL Limited would not be at loss. That means question is asking us to calculate the exchange ratio basis the earnings. Exchange ratio basis earnings. So this is EPS of NN Limited divided by EPS of MK Limited. What is the EPS of NN Limited? It's not given. We have to calculate that. So the total earnings divided by 3 lakh. This is the EPS of NL Limited. Similarly, the EPS of MK Limited also needs to be calculated. 60 divided by 12. Correct? EPS of the target company divided by the EPS of the acquiring company. So which is equal to 6 by 5. So the exchange ratio is coming out to be 6:5. Now the number of shares to be issued by MK Limited is equal to This is 3,60,000. So the total number of shares to be issued by MK Limited to the shareholders of NL Limited is 3,60,000. Now, can we calculate the EPS after merger? EPS. The earnings remain same, 78 lakhs, but the number of shares issued have increased. This is the previous estimate of 0.5:1. Now it is higher. So 5 into, oh, sorry. It should be 12 lakh. So 12 lakh is the existing shares plus 3,60,000 is are the new shares that are issued. So which is equal to 5. Okay. And can we say that what is the earnings available for equity shareholders of NN Limited, which is the target company, is actually 3,60,000 are the total number of shares, correct? Per share earning is 5 rupee. That means totally 18 lakh rupees is the earnings available. Now, don't you think, students, this is the same number that before merger also they were earning the same, correct? So after merger, they are having a 18 lakh worth of earnings available with them. And before merger, they were also having 18 lakh rupees only as per the amount given in the question. Correct? So that means it is going to be the same impact. So that means the equity shareholders of the target company, which is NL Limited, are at no loss. So hence proved that this ratio is what we have calculated is right. Now, students, just a very basic thing here is that if you calculate the EPS, okay, now let me put it here. First of all of you please note this down. I will give you 1 minute. Then I will try to explain you what I am trying to conclude from this question. Students, please ask. Again, I'm saying as many questions as possible so as to clear all your doubts and queries. Yeah, okay. Now, what I'm trying to say is, if you see MK Limited, if you see NN Limited, their EPS is 5 and here it is 6 as per the calculation. What is the current outstanding shares? 3 lakh. And I think it's 12 lakh here, correct? Yes, 12 lakh. So students, if you see 3 lakh is the outstanding shares of NL Limited, 12 lakh is the outstanding share of MK Limited, and MK Limited is currently having a lower EPS than NL Limited. So don't you think NL Limited would want, the shareholders of NL Limited would expect the higher number of shares from MK Limited compared to this 3 lakh rupees, correct? Why? Because they are saying that currently we are having a higher EPS. Currently we are having a higher EPS, and hence you have to compensate for that higher EPS by issuing a higher number of equity shares. Then only we will be at no loss. If you are going to issue us something less, Now, see, what is the market price? What is the market price? Market price is 200 and 160. Now, market price, if you see, is favorable to MK Limited. What MK Limited will say now, no, we have to disregard the EPS. We have to see from the market price, because our market price is higher than your market price of 160 rupees. So hence they will take the direction of using the market price per share here, which is the swap ratio of 0.8:1. So they will say that no, we will not be issuing you anything more than 3 lakh. Rather than we will be issuing only 2,40,000 basis the market price, because we are having a higher market price. So they will start. I mean, MK Limited will propose an exchange ratio of 0.8:1. NL Limited will propose an exchange ratio of 6:5. Correct. So if I convert this into 1, so 6 divided by 5 is equal to 1.2. So 0.8:1 and 1.2:1. Now the negotiation between both of them will start. And finally, they will be coming to some middle conclusion and doing the actual swap basis that. Correct. Because what is the purpose of what we are studying here is to arrive at these, what is the minimum or what is the maximum exchange ratio that can be put in. Correct. So Sairam is asking, sir, can we tell as it's BEP, no loss and no gain? BEP is what? Sairam, can you just elaborate on the full form? What does you mean by BEP? Okay. So 0.8:1 is the ratio suggested by the shareholders or the board of directors of MK Limited. 1.2:1 is the ratio suggested by NL Limited. Basis both of their interest, because here the MPS is higher and EPS is lower. But eventually they will end up having something like this. For example, they might end up having 0.9:1 or 1.1:1. Okay. But basis the EPS, we have calculated and we have proved also that if they calculate basis the EPS, their net earnings and the holding in the earnings remains same, which is 18 lakhs to 18 lakhs. Okay, students. So just to wrap up, at least till here, whatever we discussed, so that all of us are on the same page. So first of all, we discussed that what are the different types of M&As. Case number 1 is the case which we have taken forward and studied a lot. In this, we said that B Limited dissolves into A Limited. B Limited loses its identity and it is getting dissolved. All the assets and liabilities are transferred to A Limited, and A Limited pays a purchase consideration to either B Limited or to the shareholders of B Limited. Correct. Then case 2 is A Limited still acquires B Limited stake, and both of them are working separate companies only, like holding and subsidiary relationship. Case 3 was a hive-off. Correct. Case 4 was a forming of a new company. Correct. Then we said that the purchase consideration can be settled through 3 modes. One is the issuing of equity shares itself, but in this we said that the main point is to remember that the equity shares will be issued to the shareholders of B Limited, not to the B Limited themselves. Then there is a cash payment, and then it can be mix of 1 or 2. For issuing the equity shares, we need to know that what is the right swap ratio, and for the cash payment, we need to know that what is the right valuation. Then we said that all these things we will use for calculating the separate analysis of A Limited and B Limited, for calculating the swap ratio and doing a post-merger analysis. We studied some common formulas on PE ratio and other things. Then on swap ratio, we said that there are 3 types of calculating there are 3 ways to calculate the swap ratio. basis price, basis earnings, and basis book value. Now, either shareholders or so I'm saying either target company or acquirer company will prefer that method which it's either MPS is higher or EPS is higher. Now, for example, if the MPS of target company is higher than the MPS of acquiring company, then the target company will also say that we will follow the MPS method, because that will increase the swap ratio. I hope all of you are getting my point. See, in the last question, why we used earnings based method for the shareholders of target company, because their EPS was higher. Okay. Had it been their MPS is also higher, they would have preferred MPS, because that will increase the swap ratio. I hope all of you are getting my point. Similarly, if BVPS is higher of B Limited, they would have preferred the BVPS basis swap ratio. Correct? So this is the simple way of calculating the swap ratio. Most of the times, question will give us a indication how to calculate the swap ratio. If there is no indication given, then we will do it basis the MPS or EPS depending on the data available. Then we said that in the post-merger analysis, there are two things that we have to see. One is the effect on EPS, and second one is the gain/loss to the shareholders. So for calculating the effect on EPS, first of all, we have to calculate the pre-merger EPS, for which we have studied this and these two formulas. After pre-merger EPS is calculated, then we will calculate the post-merger EPS. In that, if the shares settlement is happening, then we will take the first case. So this is shares settlement, and this is through payment in cash. Then we will follow this route, correct? And then we said that what is the effect. Now we have calculated the pre-merger and post-merger EPS. Now effect on EPS is comparing both the EPS from acquirer and target company. From target company's perspective, don't forget to adjust it for the swap ratio, correct? Because one equity share of B Limited is not equal to the one equity share of A Limited because of the swap ratio. Then what is the value of acquisition that we have studied? Finally, the gain loss to the shareholders basis the market price. Again, we are adjusting this market price in the swap ratio and calculating the gain or loss. And we also studied that true cost of merger is actually the gain to shareholders of target company, and value of merger is actually the acquiring company's gain, shareholders gain. And free float market capitalization is nothing but the everything except for the promoters holding. Okay, Sairam has responded saying that BEP is the break-even point. There is no loss, there is no gain. Yes, so Sairam, we can say that it is a BEP, no loss, no gain from the point of view of the target company. So if you are asking for the previous question number 3 that we did, so this is, yes, you're right, this is for the BEP, break-even point for the shareholders of NN Limited. Okay. The first calculation was the BEP for the shareholders of MK Limited. The second calculation is the break-even point for the shareholders of NN Limited. Okay, students. I hope now everything we are able to match it with what we have studied in the form of formulas. Yeah, we were discussing on this question specifically from MK Limited and NN Limited's point of view. Only one thing which I forgot to tell, which I'm just adding it now, is from the point of view of NN Limited, we understood that they will always see whatever is higher, they will prefer that. For example, if their MPS is higher, they will prefer exchange ratio basis the MPS, correct? If their EPS is higher, they will prefer the exchange ratio basis the EPS. Similarly, for MK Limited also, if their MPS is higher, they will always assume or they will always prefer to calculate the exchange ratio basis the MPS. Or if there is EPS is higher, they will always prefer to calculate through their EPS, correct? So both of them will look whatever is better for them. Basis that only they will try and calculate the swap ratio. Let's come to the question number 4. Any queries? Let me just see once. Okay, yes. So question number 4 says the CEO of a company thinks that shareholders always look for EPS. He's saying that the CEO of a company thinks that the shareholders always look for EPS. They will always see EPS. Now, see, the preference is already set in the beginning of the question. They are saying that it is EPS. Therefore, he considers maximization of EPS as his company's objective. His company's net profits are 80 lakhs and PE multiple is 10.5. So first of all, again, we will just tabulate the data. PE multiple, PE ratio or PE multiple is one and the same thing, correct? 10.5 and net profits is equal to 80 lakhs. He wants to buy another firm which has a current income of 15.75 and a PE multiple of 10. PE multiple of 10 and 15.75 lakhs is the current income. What is the maximum exchange ratio that CEO should offer so that he could keep the EPS at the current level? So now students, if you see here itself, the question has told you that he wants to keep the EPS at the current level. Given the current market price of both the acquirer and target company are 42 and 105 respectively. So this is acquirer and this is target, correct? Market price per share is given as 42 and 105. That is what it is given. And it is also given to us that if the CEO borrows fund at 15% and buy out the target company by paying cash, how much should he offer to maintain the same EPS? Assume tax rate as 30%. Now, this is the second part of the question in which they are saying that instead of issuing the shares, he will pay in cash. So let's come to the first part of the question, which is the exchange ratio so that the EPS remains same. First of all, we have to calculate that what is the current EPS then, correct? So can we calculate what is the current EPS? Earnings per share. We know the PE multiple. We know the MPS. Can we calculate the EPS? Yes. EPS will be equal to MPS divided by the PE ratio. Just a second. I think there is this screen. Let me reshare it again. Yes. So technical team, is it visible now, the screen? Okay, we can start. Okay. Okay. So what I'm saying is that first of all, we have to calculate EPS, correct? Because we are given a PE multiple, we are given a MPS, and we are given the net profits also. So the EPS will be MPS divided by the PE multiple, which is, in this case, it will be 42 divided by 10.5, correct? This is equal to 4. And in this case, it will be 105 divided by 10. which is equal to 10.5. So EPS we have been able to calculate. Now, can we calculate the number of shares also? Because we have the total profits, we have the EPS. Can we calculate the number of shares? Yes. The number of shares are 20, which is how we have calculated is 80 divided by 4, which is EPS. So the total earnings divided by the EPS will give you the number of shares. Similarly, here it is 15.75 divided by 10.5, which is equal to 1.5 lakhs. This is 20 lakhs actually. So 20 lakhs are the number of shares, and the target company, the number of shares is 1.5 lakhs. Correct? Now, the question is saying that what is the maximum exchange ratio which the CEO should offer so that he could keep the EPS at the current level? What is the current EPS? 4 rupees. So ideally 4 we have to equate to 80 lakhs of profits plus 15.75 lakhs of profit, which is the target company. Are we given any synergy gain or loss in the question? No, right? There is no synergy gain or loss. So we will just take the numerator as is. Then in the denominator, we have already 20 lakhs worth of shares. Lakhs I am removing because I have not taken it in the numerator also. So 20 plus, let it be X, whatever is the new equity shares issued to the shareholders of target company. Correct? We are assuming it to be X. So that X comes out to 393,750. Simple. Shares. So the total number of shares to be issued to the shareholders of target company is 3,93,750 shares. And using this, can we calculate the exchange ratio? Yes. Exchange ratio will be 2.625 per share of target company. What we have done is we have divided this 393 by the current shares, number of shares of 1.5 lakhs. Correct? We can get the exchange ratio. Simple. Okay. So this is the first part of the question. So see students, now here we have used a simple equation to calculate, because we are given one specific situation in the question. To solve that, we have used one specific type of an equation. Now the second part, if the CEO borrows at 15% and buys out the target company by paying cash, how much cash should he offer to maintain his EPS? Assume a tax rate of 30%. Now students, the second part, can we say that assume cash payout is equal to X rupees, then what we are going to do is 4 is what we are going to equate to 80 lakhs plus 15.75 lakhs minus, correct, X multiplied by what is the rate that he would have borrowed is 15%, correct? So the impact to him, the opportunity cost to him will be 15% of X. But on that, there is a tax implication as well, because he could have been able to save a tax also. So that means the loss will be lesser. So this is 1 minus 30%, which is the tax rate. This whole divided by the current number of equity shares, which is 20 lakhs. Correct, students? So this is what the equation is. Now, if we solve this, then X comes out to okay, so just a second. 80 lakhs plus 15.75 is what their current respective profits is. From that, we have reduced whatever cash we will pay. On that, what is the opportunity cost multiplied by 1 minus tax and whole divided by the 20 lakhs. So 95.75 lakhs minus 0.105x is equal to 80 lakhs. Hence, x is equal to 150 lakhs. So the amount of cash required to be paid is 150 lakhs. Then only he will be able to maintain the same EPS after merger. Because if you put instead of X here 150, you will get 4 rupees EPS per share. Okay, students. Meanwhile, you note it down. Yeah. So this is how the calculation will look like. Okay. Now let's go to the next question. Question number 5. Now A Limited wants to acquire T Limited and has offered a swap ratio of 1:2. Now they're saying that the swap ratio is 1:2, which is 0.5 shares for every 1 share of T Limited. So A Limited is the acquiring company, T Limited is the acquirer company. For both of them, they have given a certain information: PAT, equity shares, EPS, PE ratio, and market price per share. All these things are given. Then required the number of equity shares to be issued by A Limited for acquisition of T Limited. See, first part is very easy. Why? Because we don't even have to calculate the swap ratio. Swap ratio also they have already given. Correct. So let's start. Number of equity shares to be issued, correct, is equal to 0.5 multiplied by what is the outstanding number of equity shares? 1,80,000 for the target company, correct? For every 1 share, they will issue 0.5 shares of the acquiring company. So this brings the total equity shares to be issued as 90,000. So the first answer is 90,000. Okay. Now coming to the second part. What is the EPS of A Limited after the acquisition? Now see, they are asking us to calculate after acquisition. What is the EPS? Simple. That means EPS after merger. Now, is this a case of issuing the equity shares? Yes. That means, and is there a synergy gain? No. We will take the total gain, total profits divided by the total number of shares. It is also very easy. EPS post merger. So what are the different profits that both of them earn? 18 lakh and 3,60,000. So 18 lakh, 3,60,000. This whole divided by what is the current equity shares outstanding? 6 lakhs. And what are the new equity shares being issued is 90,000. as per the step 1 above, correct? So this will be 21,60,000 whole divided by 6,90,000. Hence the EPS is equal to 3.13 per share. This is the EPS post merger, correct? So 2160 yes, this is right. 3.13 per share. Okay. Now the third part, determine the equivalent earnings per share of T Limited. Equivalent earnings per share of T Limited means they are asking us to calculate the swap ratio adjusted EPS post merger. Simple. So equivalent EPS of T Limited is what? What is the EPS? Currently 3.13. In this, we will just multiply it by 0.5, which is the current swap ratio. Simple. So this will give us 1.57 per share. So what one share of, what is the acquiring company name? What is one share of A Limited is able to earn, which is 3.13. Similarly, the one share of T Limited would be able to earn 1.57 because the ratio between both of them is 0.5 is to 1. Simple. So that is called as equivalent EPS of T Limited. Then next part, what is the expected market price per share of A Limited? What is the expected market price per share of A Limited after acquisition, assuming its P multiple remains unchanged? Now they are saying us to calculate the expected market price after acquisition and the P ratio remains same. Now simply we will use the EPS and multiply it with the P ratio to arrive at the market price after merger. Expected market price A Limited after merger, correct, is what we have to calculate. So what is the P ratio? Because the question is saying the P ratio will remain same. P ratio, there is no change, which is 10 rupees. What is EPS? 3.13 rupees, which we have already calculated in the second step. So that means 31.3 per share is the MPS after merger, which is the expected number. Determine the market value of the merged firm, which is again very easy. Market value of the merged firm means 31.3 multiplied by the total number of equity shares. Total number of equity shares are how much? 6 lakhs are the present one, and 90,000 is what they have issued during the merger. That means total is 6,90,000 multiplied by 31.3, which gives us 2,15,97,000. This is the total market value of the merged firm. I'm getting a sneeze, sorry. Yeah. Okay, students. So 2,15,97,000 is the total market value of the merged firm. Question number 5 done. Now let's come to the next question. Okay, let me give 1 more minute for all of you to note it down. Then we will move to the next question. Actually, if you see these questions, all these questions are based on the same principles, which is what would be the right swap ratio, what is the post-merger analysis, both based on EPS, MPS, and there is a use of P ratio. So we need to just figure it out using what details we have to calculate what. Okay, with the flow of question. Now, question number 6 says the following information is provided related to the acquiring firm Mark Limited and the target firm Mask Limited. Okay, there is a acquiring firm called Mark Limited and there is a target firm called Mask Limited. Now, don't get confused in the names. The acquiring company is given first, the target company is given later. They have given earnings after tax, number of shares, and PE ratio. All things they have given. Required. What is the swap ratio based on the current market prices? Simple. We have to first calculate the market price. Is the market price given? No. So we can calculate the market price. Okay, let me put all the details here. Mark Limited, Mask Limited. Okay. So for Mark Limited, first of all, the earnings are given as 2000 lakhs and 400 lakhs. Number of shares 200 lakhs and 100 lakhs. Can we say that what is the EPS first of all? Because see, now we have to calculate the market prices, right? For calculating the market prices, we already are having the PE ratio, but we need the EPS. If we multiply PE ratio and EPS, we will get the market price. Okay, so the EPS is how much? 2000 divided by 200 is 10. 400 divided by 100 is 4. These are the respective EPS. Now, what is the PE ratio? PE ratio is 10 and 5. That is given in the question. What is the MPS then? Market price per share. 10 into 10, 100. 4 into 5, 20. So to calculate the first part, swap ratio will be 20 divided by 100. Correct? Which is equal to 0.2:1. For every one share in Mask Limited, 0.2 shares of Mask, for every one share in Mask Limited, 0.2 share of Mark Limited will be issued. So first part is done. Okay, students, so this was very easy to calculate. Let's go to the second part. What is the EPS of Mark Limited after acquisition? So they are asking us to calculate after acquisition, what is the EPS? So first of all, do we have the earnings for both of them? Yes. 200,000, 2000 lakhs and 400 lakhs, correct? So the EPS Mark Limited after merger. $2,000 lakhs plus 400 lakhs whole divided by what are the current number outstanding? 200 lakhs plus another 20 will be issued, correct? 0.2:1 is for 100 lakhs, 20 lakhs further will be issued to the shareholders, right? 20 lakhs. So in totality, 2400 divided by 220, which gives us 10.91 per share. So the EPS of Mark Limited will be 10.91 per share. Correct? What is the expected market price per share of Mark Limited after acquisition, assuming the P ratio of Mark Limited remains unchanged? So that means they have given us the same ratio and asking us to multiply. Simple. So the expected market price is EPS 10.91 multiplied by the existing P ratio, which remains unchanged, which is 10 times 109.1 per share. This is the expected market price. Okay, all of you please note it down before we go to the next part. Okay, yeah. Now let's go to the next part. Determine the market value of the merged firm. The market value of the merged firm will be MPS multiplied by the total number of shares, correct? $10.91 multiplied by 220 lakhs. Correct? These are the total number of shares, 220. So that means value comes out to be 24,002 lakhs. What is the last part? Calculate the gain loss for shareholders of the two independent company after acquisition. Very simple. Now, gain loss, we have already seen how to calculate the gain or loss for the shareholders based on the market prices, the respective market prices, but we have to adjust it for the swap ratio. And another way to calculate the gain or loss, correct? See, that is a simple formula which all of us can apply that I have mentioned there earlier in our notes. But in this case, we will just see another way to calculate the gain or loss. Can we say that as per the fourth step, the market value is how much? 24,002 lakhs, correct? Now the shareholders, the shareholding percentage for Mark Limited and Mask Limited, can we calculate? Yes, we can calculate. This is 200 by 220 into 100, which is around 90.91 percentage. This is 20 by 220 into 100, which is equal to 9.09 percentage. Correct? These are the respective percentages that are there. Now, in Mark Limited and Mask Limited, what is the value split basis the above shareholding percentage? $24,002 multiplied by 9.09 percentage. Correct, students? Because here you have a 90.91% stake in the overall valuation. Here you have only the 9.09 percentage stake in the entire valuation. Correct. So this will give us that what is the right number, and hence the value that comes, the value split between both of them is 21,820, and here it is 21,882. and we can reduce the pre-merger value. What was the pre-merger value of the acquiring company? Market price is 100. Number of shares was 200 lakhs. So that means 20,000 was the pre-merger value, correct? 200 multiplied by 100. Similarly, here it was how much? Market price is 20. Number of shares were 100 lakhs. So it is 100 multiplied by 20. 2,000 here and 20,000 here. So 1820 is the gain coming out to be here, and 182 is the gain coming out to be here. So after the merger, both of them have gained. Acquiring company have gained to the extent of 1820 lakhs, and target company, which is the Mask Limited, has gained to the extent of 182 lakhs. This is the exchange ratio that is given in the question. Which is nothing but the first part that we have calculated, correct? So actually there is nothing big in these questions. These are very basic questions depending on the understanding that we have created already. Let's come to the next question. Okay, let me give one more minute to note it down, for all of you to note it down. Okay, let's go to the next question, which is question number 7. Now, XYZ Limited wants to purchase ABC Limited. Again, it's a similar kind of a question where one company is trying to purchase another company, and they have given the exchange ratio also 0.7 of its share for each share of ABC Limited. So the exchange ratio is 0.7:1. They have given us some information. Equity share, EPS, market price. Illustrate the impact of merger on EPS of both the companies. First of all, they are saying that illustrate the impact of merger on EPS of both the companies. So that means we have to calculate the, we have to see that what is the pre-merger EPS and post-merger EPS. Simple. So this is called as impact of merger. Okay. So there are two companies, XYZ Limited and ABC Limited. Number of shares 10 lakh and 4 lakhs. That is given to us. EPS is also given to us, 40 and 28. Earnings will be how much? 10 lakh into 40, correct? Which is 400 lakhs. It's 4 lakh into 28, which is 112 lakhs. Here we have done 10 lakhs multiplied by 40 just to say from where we have got it. And here we have done 4 lakhs into 28, which is 112. And the PE ratio is basically 250 divided by 40, correct? Because the market price is given as 250 and 160 respectively. So the PE ratio we can calculate as 6.25 because in the upcoming part, we will make use of this PE ratio. Hence, we are going to calculate this 160 divided by 28. So this comes as 5.71. We have the PE ratio, we have the earnings per share, and we have the MPS as well. Now, issue of shares will happen as 0.7 times of current shares outstanding, which is 4 lakhs. So in totality, we will end up issuing 2,80,000 shares, correct? So the EPS post merger, it will be simple now. 400 lakhs plus 112 lakhs divided by the current outstanding shares of 10 lakhs plus 2,80,000. This is all in lakhs. So this gives us EPS post merger as 40 rupees. Students, again, I'm saying please put queries, doubts, anything which you have. Only then I will be able to know that whether we are going on right track or not, correct? Because otherwise I will also modify the way of teaching then, okay? In case there is some difficulty to anyone, please do let me know. So EPS post merger is equal to 40. Now we can calculate the impact simply on XYZ and ABC. The EPS after merger is, we can take straight away 40 here, but here we will have to take 40 adjusted for the swap ratio, which is 28 rupees, correct? We cannot take 40 as is, we have to adjust it for the swap ratio. EPS before merger. Here also it was 40, correct? We have just calculated 40 and 28. Sorry, it was given in the question, right? And here also it is 28. Nil, nil. There is no impact. Impact is nil. Simple. There is no impact at all. Why? Because the ratio is maintained in such a manner that both the EPS will be constant. It is 0.7. Correct. Now, the next part. The management of ABC has quoted a share exchange ratio of 1:1 for the merger. Now, they are saying that instead of 0.7:1, we will go, the target company is quoting a higher exchange ratio. They are saying 1:1. Assuming that the PE ratio of XYZ Limited remains unchanged after the merger, what will be the gain from merger? Students, please note, gain from merger for ABC Limited. They're asking us to calculate the gain from merger. And since they are saying that the PE ratio remains unchanged, the question is also asking us to calculate the price after merger. Using that price only, we are calculating the gain from merger. Simple. Now we have to base our question on exchange ratio if it is 1:1. Exchange ratio, if it is 1:1, then EPS is equal to 400 plus 112. This is the common thing. And it will be 10 lakh plus 4 lakhs, correct? Because 1:1, 4 lakhs shares is what we have to issue. So hence in totality, 14 lakhs. Shall I put 10 plus 4 here for the clarity? Okay, 10 lakh plus this 10 lakh plus 4 lakhs. Okay, so this gives us the EPS of 36.57 per share in case the exchange ratio is defined as 1:1. And the PE ratio, which is already we have calculated, and it is saying that it will remain unchanged, is 6.25. So the MPS post merger comes out to be 36.57 multiplied by 6.25. Correct? This is MPS post merger, which is 228.56. Hence, the gain to ABC will be 228.56 multiplied by the exchange ratio, which is 1:1. Hence, we will multiply it with 1 because we have to calculate the swap ratio adjusted market price, because we are talking from the target company's point of view, right? We are talking about the gain from target company's point of view minus what was their pre-merger market price, that was 160. Correct? That is given in the question. So that means they are able to make a gain of 68.56 rupees per share. Simple. Okay, students. So the gain to the ABC Limited shareholders per share that they hold in ABC Limited is 68.56 rupees per share. Now, you can please note it down. Then we will go to the next part. Okay. Now let us see the next part. What will be the gain or loss to the shareholders of X Limited? Now they are saying that calculate the gain or loss from the point of view of X Limited. That also we can calculate. Gain slash to shareholders of XYZ Limited. So the market price of the merged entity is how much? Market price of the merged entity is 228.56 minus market price before merger of XYZ was how much? I think 200, right? Where is the market price? 250, sorry. Yeah, 250. It's 250. So there is a loss then to them, which is 21.44 rupees. This is a loss to them because before merger, they were having a higher MPS, higher market price per share. But after merger, their MPS got reduced. So this is loss from merger. Okay. Now, the last part says determine the maximum exchange ratio acceptable to the shareholders of XYZ. Now, simply going by this logic of 1:1, there is a loss to shareholders of XYZ Limited. Correct? As now we have seen. So hence the question is asking now, as per XYZ Limited, what should be the maximum ratio that they are willing to quote? Correct? Okay, now let us try to see that. Now think how XYZ Limited will have a working. So the total earnings is how much? 400 plus 112, correct? Which is 512 lakhs. The P ratio is how much? See what they will do now, they will say that, okay, what should be our total market value? And from that, we are going to calculate the exchange ratio. Okay. So now the P ratio is how much? 6.25, which remains unchanged. That is already given. So 512 is the total earnings. P ratio is 6.25. Can we know that what is the market value? What's the total market value that we are going to have? Which is 3200 lakhs, which is nothing but 512 lakhs multiplied by 6.25. 512 multiplied by 6.25, which is 3200 lakhs. Now, this should be the total ideal value of the entity after merger, which is 3200 lakhs. Already, they have an existing value, correct? I'm talking about XYZ Limited. So value of XYZ Limited before merger. It's how much? It's 2500 lakhs. This how we have calculated number of shares multiplied by the market price. 10 lakh multiplied by 250. Correct. So this is 10 lakhs multiplied by 250, which is 2500 lakhs. So the value of merged entity becomes as 700 lakhs. Correct. That means the value of target company, I'm saying, trying to say, that becomes a 700 lakhs. What is the current market price? The current market price of the acquiring company is 250, which they don't want to dilute. Correct. Hence, the number of shares that will be issued is 700 lakhs divided by 250, which is 2.8 lakhs. So hence, the number of shares that they will be willing to issue is 2.8 lakhs. Hence, the maximum exchange ratio is equal to 2.8 is to 4 lakhs, correct? Which is further equal to 0.7 is to 1. So this is the maximum exchange ratio that they will be willing to offer from XYZ Limited's point of view. Okay, students. Let us go to question number 8 now. I hope we have covered this question. Yeah, we can go to the question number 8. So the question number 8 says that Longitude Limited is in the process of acquiring Latitude Limited, okay, on a share exchange basis. So they're saying it's not a question of outright purchase. I mean, it's not a question of settlement through cash. It is a question on settlement through shares. Following relevant data are available. Longitude Limited and Latitude Limited. PAT is given. Number of shares are given. Earnings per share is also given. And the P ratio is given. And they have mentioned that ignore synergy. You can ignore the synergy. You are required to determine the pre-market market value per share. For both of them, definitely. That we can easily calculate. Longitude. Second one is latitude. So the PAT is how much? 120. And here the PAT is 80, right? The number of shares. This is in lakhs, correct? This PAT is in rupees lakhs. So the number of shares are 15 and 16 that are issued. 15 and 16. Correct? PAT is given, number of shares are given, and EPS is also they have calculated and given to us simply. 8 and 5. PE ratio is given as 15 and 10. Hence, the MPS comes out to be 15 multiplied by 8, which is 120, and 5 multiplied by 10, which is 50. So the market price per share also we have calculated. So this is the pre-merger value, right? Pre-merger MPS is equal to 120 and 50 respectively. So that is the first part of the question. Second part, it is saying that the maximum exchange ratio Longitude Limited can offer without the dilution of EPS and MPS. So they are saying that if they don't want to dilute their EPS, then what is the exchange ratio? If they don't want to dilute the MPS, then what is the exchange ratio? That means they are asking us to equate the current EPS with the expected EPS in the first part, and second part, the current MPS with the expected MPS. So the second part, A part, we are covering EPS to be same, correct? In that, we let us assume to be X, let number of shares be X. Now, what is the current earnings? 120 plus 80, correct? For both of them put together, 120 PAT and 80 PAT, correct? Divided by, what is the current number of shares? 15 plus X, correct, is equal to the current EPS of 8 rupees. Simple. This is the equation. Using this, if we solve X, we get 10. That means 10 number of shares we are going to issue against 16. So the exchange ratio will be 10:16. So the 10 lakhs shares for 16 lakh shares. Exchange ratio will be 10:16. That is 0.625 per share. This is the exchange ratio. Now the B part says that MPS to be the same. MPS to be same. In that we can equate the MPS. Now 120 multiplied by 15 is the current value. 50 multiplied by 16 is the current value for both of them respectively. And 15 plus X is what we are going to issue. And 120 is the current market price, which we are going to equate to it. Correct? So X, if we solve this, it comes as 6.67 lakhs shares. So for every 16 lakh shares, 6.67 lakh will be issued. That means the exchange ratio will become as 6.67:16. Or we can say 0.41:1. This is the exchange ratio that is acceptable for the maximum. This is the maximum exchange ratio acceptable for making the MPS to be the same. In the first part, we have taken the EPS to be the same. In the second part, we have taken MPS to be the same. Simple. It is a simple mathematics. So question number 8 is done. Then let's come to the question number 9. Sorry. Let's come to the question number 9. Let me increase the size a bit. Okay. Now, question number 9 says that P Limited is considering takeover of R Limited. Okay. By the exchange of 4 new shares in P Limited for every 5 shares in R Limited. So the exchange ratio is 4:5. Simple. The relevant financial details of the two companies prior to the merger announcement are as follows. P Limited, R Limited, profit before tax is given, number of shares is also given, and the PE ratio is also given. The corporate tax rate they have given as 30%. You're required to determine the market value of both the companies. So first of all, they're asking us to calculate the market value. So we can easily calculate the market value. Okay, let us just put the data here. P Limited, R Limited. So the PBT, profit before tax, is given as 15 and 13.5. Now students, please note, till now in every question they were giving us PAT. Now they are giving us in PBT and they have given us a tax rate as separately. So we will take the tax impact first and then we will do the further things. So 30% on 15 comes as 4.5. 13.5, 30% comes as 4.05. So this is 10.50 as PAT. $10.50 as PAT. This is PAT. And this is 9.45 as the PAT of R Limited. Now the number of shares is given as 25 and 15. 25 crores and 15 crores. P ratio is 12:9. Sorry, P ratio is not 12:9, 12 and 9. Sorry, it is 12 and 9. Market value. Can we calculate the market value? Yes. The price per share is how much? See, the EPS is how much? First of all, the EPS is 10.5 divided by 25, correct? That is the EPS multiplied by the PE ratio. This will give us MPS, correct? Market price per share. Similarly, here if we calculate, PAT is 9.45, number of shares are 15 multiplied by 9. Okay, Shubham, we will give the email ID. Okay, so 9.45 divided by 15 into 9 is what the MPS is. If we calculate both the numbers, it is 5.04 per share and it is 5.67 per share. This is what the MPS is, and the value, which is the market value, will be 5.04 into 25 crores. 126 crores is the market value here, correct? I have just multiplied with the number of shares, and 5.67 multiplied by 15, right? 15 crores. So 5.67 multiplied by 15 comes as 85.05 crore. This is the market value, correct? Now first part is done. Second one is value of original shareholders. Now what they are asking is the value of the original shareholders. See, first of all, we have independently calculated the market value of both the companies. Can we calculate that what is the merged entity value? 126 plus 85.05. This is how much? 211.05 crores. Correct? And hence the number of shares in merged entity that both of them have is 25 crore is what they have already. So we are now, after this, we are calculating the calculations for total merged entity. Okay. The total merged entity, we have calculated the total value is this, market value is this. We have just added the market value. The number of shares is 25 crores in the original company, and they will issue how much to the new company? 15 into 4/5. That is the swap ratio, correct? So they will issue another 12 crores to the shareholders of the dissolving company, which is R Limited in this case, right? Yeah, R Limited. So the percentage, can we calculate? 25 divided by 25 plus 12, correct? Which is 37. And here also 12 divided by 25 plus 12. So this will give us, they have a holding of 67.57%. Similarly, our limited shareholders have a holding of 32.43% in the respective capacities in the new company. So the value of original shareholders is how much? That is what they're trying to ask, correct? In the second part, they're asking what is the value of original shareholders. So the value of original shareholders is, we can just simply multiply this percentage holding to the new value of the entity. Simple. Multiplied by 211.05 crores. This comes as 142.61. And here, if you multiply 32.43% into 211.05 crores, it comes as 68.44 crores. So this is the right value split between both the shareholders. One is for the acquiring company, which is P Limited, and one is for the target company, which is R Limited. Okay, students. So this is how the value of original shareholders is calculated. You can please note it down. Then we will move to the next part of the question. So the next part of the question says that price per share after merger. What is the price per share? MPS after merger. Simple. So the price per share after merger, we have to calculate the EPS first, correct? Price per share after merger can be calculated using, first of all, what is the EPS? Earnings per share, correct? So the total earnings is how much? 10.5 plus 9.45, correct? So that is the total earnings. 10.5 plus 9.45, which is equal to 19.95, correct? And what are the total number of shares that are issued? The swap ratio is already given in the question, 4/5. And we, in the previous part only, we calculated what are the number of shares that are to be issued, which is 12, correct? So 25 are the existing and 12 will be the new issue. So that the revised or the new EPS after merger comes as 0.539 per share. Correct, students? So this is the EPS. Then, do we know that what is the P ratio? Yes, the P ratio is 12. Can we calculate the market price easily? So the MPS is EPS into P ratio. So hence 0.539 multiplied by the P ratio of 12. So this comes as 6.47. So the market price after merger comes out to be 6.47, and hence the market value after merger is equal to 6.47 multiplied by 37 crores, which is equal to 239.39 crores. Yes. Okay, students. So this is what the market value after merger will look like. Now the last part says that effect on share price of both the company if the directors of P Limited expect that their own pre-merger PE ratio to be applied to the combined earnings. That is what we have done in the previous step also, correct? We have applied their current PE ratio of 12 to the combined earnings. That is how we calculated the price per share after merger. Now they are saying that you have to calculate the effect on share prices, that is the gain/loss for the respective shareholders, correct? So we will calculate in the last part, we will calculate effect on share price. Now this will be calculated from both the company's point of view. First, we will take P Limited. P Limited, it is very easy, 1:1. There is no swap ratio because already P Limited is the main company, is the acquiring company, correct? So we will just simply calculate the gain or loss. So the after merger, P Limited share price is equal to 6.47. What was the pre-merger share price? Pre-merger share price was 5.04, correct? That we have calculated in the first part. Yes. So this is 5.04. Hence it is 1.43. So the gain, this is a gain, right? Because the value has increased. The gain to P Limited's shareholders is this much. And since the question is asking us to calculate the effect, correct? So in percentage terms also, if we want to calculate, we can say that 1.43 divided by 5.04 into 100, correct? In terms of percentage effect, if we say this will be like this, and it will say as 28.4% of gain. Simple. This is the impact on P Limited's share price. Okay, students, this is the P Limited. Now, if we have to see it from the R Limited's point of view, which is the target company, correct? So we can say that post-merger, P Limited's price adjusted for swap ratio, correct? This is what we have already studied, why we are adjusting for the swap ratio, because one share of R Limited is not necessary to be equal to the one share of P Limited. Both of them are equated through a different exchange ratio. Hence, we have to consider that swap ratio here to do the impact analysis, correct? So here it will come as 6.47 is the price, multiplied by 4/5 is the swap ratio, 5.18 per share. $5.18 per share is the post-merger equivalent price of R Limited shareholders in P Limited, correct? Minus pre-merger R Limited's price. That also we calculated as 5.67, correct? So this is 5.67 per share, and hence there is a loss here, correct? Because previous to the merger, they were having a share price of 5.67. After merger, they're having a price of 5.18. That means there is a loss of 0.49 per share. Loss to R Limited's shareholder is equal to this. And effect in terms of percentage, we can say that minus 0.49 divided by 5.67 into 100. This comes as minus 8.64 percentage. Correct? So this is the loss or percentage effect of loss on the R Limited's share price. Okay. Now, students, next question we will take up in the next class because I don't think so we will be able to cover it properly within the time limit left. Okay. So you can note these things down. Yes, sir. So see, Ashish sir is there with us. So
am I audible?
Yes, sir. You're audible, sir. Yes.
Okay. So your session is over now. Actually, there's some connection issue there.
Yes, sir. Yes, sir. Yes, sir. My session is over because if we start the next question, it will take some time. So we will start in the next session.
Okay.
Sir, it is not audible.
1 second. Am I audible?
Yes, sir. Now it is better.
Actually, there was one query regarding it was asking for email ID. So
Yes, sir. Yes, sir.
Jot down the email ID that the student can
Yes, sir.
send the query.
Yes, sir.
It is SFM dash final @ICI.in. It is all in.
Hello. Okay. So students, you can note it down. This is the email ID on which you can send all your queries, any doubts, anything related to it. So this is sfm-final@ici.in. This is all in small letters. I've put it in bold letters so that everyone can see this. Okay.
Okay.
Ashish sir has joined. Yes, sir. Yes,
Yeah,
sir.
no. There was some. Okay. It is all in small letters, and my contact
Yes.
number. Our contact number is 0120 30 45 956. Okay, student. So you can contact me also or the telephone, or you can send us the email at this email ID. Of course, we shall reply your queries. Okay, Divas, thanks a lot for your lecture on the today's topic, and
Thank you, sir.
we shall deal this topic in day after tomorrow's class. Till then, you
Yes, sir.
revise what has been discussed in today's class. And sorry for
Yes.
the technical glitch that has taken place because there are some network issue here from the office.
No, sir.
So of course, I will
Yes.
ensure that this will not happen in the next class. Thank you. Okay.
Sure.
Have a nice
Thank you,
day.
sir. Thank you, sir. Okay. Thank you, sir. Thank you.